Hello everyone, my name is Aashish Somaiyaa and I am the Managing Director for Motilal Oswal Asset Management Company. I am here today to address one of the most commonly faced queries that we get from our advisors and distribution partners, which is very commonly asked to us. And this query is about what are the differences between an equity PMS and equity mutual funds. And we face this query more so specifically because we are one of the few players who has been running a successful business on both sides, whether it's equity PMS as well as equity mutual funds. So in the next couple of minutes, what I'm going to do is I'm going to share 3 or 4 points with you in terms of how these two are different. And my first point is that as an advisor or a distributor, I think that everybody must have both of these offerings in their portfolio of offerings for their investors. Just as a question, how many of you will agree with me if I say that the market for PMS is actually much larger than the market for equity mutual funds? I'm sure this would come as a surprise to you, but I would just like to share 2 simple data points on this. If you take our entire market cap, it's about 100 lakh crores. And out of this 100 lakh crores, approximately 13 to 14 lakh crores or 13 to 14% is by way of what we call retail holding or non-promoter, non-institution holding. This means this is basically people who are not promoters, not FIIs and not domestic institutions. These are individuals who are holding shares in their demat accounts. So theoretically speaking, my market for PMS is basically everybody who is holding equity shares in their demat account. A lot of them may be taking advice from their broking partners and executing transactions on their own. But let me also tell you that out of this 13 to 14 lakh crores, if one were to make calculations on cash volumes and how much of the portfolio is being turned over, you will actually realize that a large part of demat holding is actually dormant in nature and is not being managed in favor of investors. So, if you see, there are mutual funds in existence since 1964. In about 51 years, the corpus of equity mutual funds has reached about between 3.25 to 3.5 lakh crores. Whereas the cult for equity started with the listing of Reliance in the late 70s, and in a span of about 35 years, what we've noticed is that direct holding of equity has reached about 13 to 14 lakh crores. So that's the first point, which leads us to believe that at least theoretically, the potential market for equity PMS is as much or larger than that for equity mutual funds. And if we are actually expecting that all the people who are holding equity shares in their demat accounts are going to sell all of that and move into equity mutual funds, then I think that's a theoretical expectation. I don't think it is happening. If it had to happen, it would have happened by now. So the biggest advantage for a PMS is that theoretically speaking, anybody and everybody who has equity shares in their demat account can be encouraged by telling them that don't do it yourself, allow a professional manager to do it. Because in a PMS, at least 30 to 40% of our client engagement starts off by evaluating an existing portfolio and eventually the client transferring an existing portfolio for us to reorganize and manage and then take it forward from there. The second data point which I wanted to share with you is that I just told you that about 13 to 14% of the entire market cap is retail holding by way of equity shares in demat accounts. So in the full market cap, it is 13 to 14%, but you'll be surprised to know that as far as Nifty is concerned, the retail holding is below 4% or just about 4% actually. What this means is that if there are 7,000 listed companies, and in 7,000 listed companies, if the retail holding is 13 to 14%, but in the top 50 companies it's less than 4%, it means that in the long tail of about 6,900 odd companies, the retail holding is well about 20%. So if I were to make a statement that as you go up on the quality of companies, retail holding goes down, and as you go down on the quality of companies, the retail holding actually goes up, that means it would make even a stronger case for portfolio management services as an offering. And I would just like to recap at this stage that if we expect all these people to move out of their equity shares and transfer the money into equity mutual funds, I don't think that is happening. The only alternative is to counsel these clients to appoint a professional manager by transferring their securities to us. So that's the first point. Carrying forward in terms of differences, I think one of the key differences which works in favor of a portfolio management service is, for a house like Motilal Oswal AMC, where we profess to buy right and sit tight. If you see a mutual fund, it's a pooled vehicle. And generally what happens with mutual funds is that when the markets are booming and the performance is great, we always, whether we like it or not, we always witness a huge amount of inflow. And the converse happens when the markets are bad and the performance is bad. People vote with their feet and you tend to see outflows. So in a mutual fund, what tends to happen is that because of continuous inflows and continuous outflows and the portfolio being managed as a pool, on the margin every day the portfolio either gets diluted or concentrated depending on whether there are inflows or outflows. Whereas if you look at a PMS, in a PMS, an individual client's portfolio is held in that client's segregated demat account, and as a result of that, the sum total of actions of the other subscribers of the PMS doesn't impact any individual's portfolio. So, for instance, if you were to subscribe to a PMS service today, at today's buying prices, your shares would be credited in your demat account. And after that, as many customers may come in or may go out, it has no impact on the shares which are credited in your account at your buying price. So this is something which is which causes a fair amount of difference in terms of how a PMS behaves versus how a mutual fund behaves. Because in a mutual fund, on the margins, like I mentioned to you, the portfolio keeps getting diluted on a daily basis. Whereas in a PMS, for every client, a model portfolio is managed on a segregated basis. This is the second difference. Coming to the third difference, as far as a PMS is concerned, now this works positively as well as negatively at times, but as far as a PMS is concerned, there are no limits on individual stock holdings. As we all are aware, in a mutual fund, no stock can be more than 10% of the portfolio for a diversified fund. So somewhere this means that in a mutual fund, as a portfolio manager, on the margin you are forced to sell your winners. Every time a stock crosses 10%, it is absolutely mandatory. In fact, somewhere around 9.5% is when we would start trimming. It's absolutely mandatory to ensure that whatever the performance case may be, no stock can exceed 10% of the portfolio weightage. In a PMS, at our end, of course, because we want to exercise some risk control, we put hard caps at 20%. We never let a stock cross 20%, and in fact, the moment a stock starts crossing 15% is when we start trimming. But let's just give an example that a stock doubles in a period of 3 years. You have 4% allocation to it and I have 14% allocation to it. Obviously, I would get 3 times more return than what you would get. And just to qualify my statement, it would work on the negative as well. So while there are risks associated with running concentrated positions, the limited point I'm trying to make is that by running concentrated positions in a buy right, sit tight, high conviction fashion, at least one can believe theoretically that a PMS has the potential to outperform. Whether it may actually happen or not, one has to study the numbers and consider all other factors. The third point in terms of differentiating a PMS and a mutual fund is that obviously we know that in a mutual fund there are only two so-called plans or share classes. There is a direct and there is a regular. Whereas as far as PMS is concerned, there is a huge amount of flexibility with fee structures and expense ratios. And depending on the size of investment, it's obvious that we would not customize fees for each and every client, but depending on the slab of investment, there can be differentiated fees which may be charged. The other option that a PMS leaves on the table obviously is to charge performance linked fee and keep the fixed expense much lower. So these are some of the key differences as far as a PMS and a mutual fund is concerned. The last point I would say is more on the negative side, what works against a PMS. As we all know, a mutual fund is held under a trust, and it's in that sense, as per section 1023D of the Income Tax Act, a mutual fund is a tax advantaged vehicle. Just to elaborate, when a mutual fund buys and sells securities, because it's a trust, the mutual fund does not pay any tax. Whereas as far as a PMS is concerned, it's just like an individual buying and selling shares directly in the market. So in a PMS, every time we sell a stock in less than 1 year, if there is a gain, then that gain would be liable to short-term capital gains tax. And anything which is sold after holding for a year, that would be tax-free because there are no taxes on long-term capital gains in equities. So in a PMS, if one were to have a trading strategy, then definitely it would be at a serious disadvantage compared to a mutual fund. Having said that, I would like to clarify that at Motilal Oswal, because we profess to buy right and sit tight, and our average holding period for stocks is well over 3 to 4 years. We end up, there are times obviously when we end up passing short-term capital gains to investors, but the incidence is minimal. Having said that, it is definitely a distinct disadvantage for a PMS because it is not a tax advantaged vehicle, whereas a mutual fund being a trust has serious advantages as far as taxation is concerned. So I hope this has been useful to you. These are the few differences or clarifications I wanted to share about PMS versus mutual fund. In the end, I would just like to give you two parting thoughts. Number one, always keep in mind that the retail holding by way of equity shares in people's demat accounts, that part of the market is 4 times the current size of the equity mutual fund business. Equity mutual funds are ideal for people who have been investing in fixed income, or who are conservative, or who are retail investors, or people who want to do SIPs. But PMS is an ideal offering for people who are used to holding equity shares in their demat account. You just need to go to them and tell them that they need to appoint a professional manager rather than doing it themselves. And lastly, I would like to clarify to you that at Motilal Oswal AMC, we manage approximately 4,600 crores by way of equity PMS, and we manage another about 4,000 crores by way of equity mutual funds. Both the businesses are equally critical to us. We employ the same investment philosophy, and we manage both the businesses with equal sincerity. So at my end, I have no favorites, but the idea of sharing these thoughts with you is to enable you as an advisor or distributor to understand that both these offerings are targeted at different segments of customers, and you should be keeping both of them in your repertoire. So thank you very much for listening me out. It's been a pleasure talking to you.